What is going on, guys? Welcome back. In today's lesson, we're going to be going through trading the gap. I'm going to be introducing to you guys gap theory, the different various types of gaps that there are, how to enter on gaps, where to manage your stop loss, etc. So without any further ado, let's get right into it. I have kind of formed this the way that we did the Elite VIP course, which has dozens and dozens of hours of content on the members website, but we're going to be doing this this way now because it's a lot easier for you guys to understand. So firstly, we're going to go through some theory, and I'm going to tell you guys just some very common things about them, and then we're going to go through charts. I'm going to show you guys how to use it as well. So let's get right into it here. Now, gap theory, there's four different types of gaps that there are. So there's your common gaps, so you can call them your normal gaps, whatever you want to really call them, it doesn't matter. But the first one is that, and it's just simply a gap, okay? So a normal gap that you see in the price action, a very small one, and it doesn't really do anything big with the price action. You can still capitalize on it, and we will talk about these small gaps and how you can actually make money on those gaps, of course. But they're not like the bigger gaps that are going to really give you those big trades and those trend directions, etc. Now, a lot of people think that you just trade the gaps as they fill, you play bounces, etc. But you can actually get in on, if the gap, gaps up, you may be able to get in on that and capitalize on that move. So that's where, breakaway gaps come in. So the second thing, breakaway gaps. Now, this is signaling a new trend in the market. Price action starts to gap away from the trading zone, and you see an expansion in the volume. If you do see an expansion in the volume, then that's typically telling you that this move is able to be maintained, and it's a good idea to get in on that trend. So it's not like you're just looking for a gap, and as the gap gets created, you're trying to get the gap to fill, and then you're going to play the bounce, for example. You're not trying to just always do that, right? You can do that, and it can be profitable, but you can actually be looking for breakaway gaps in the trend, and then getting in that breakaway gap and getting some very, very big trades in that specific direction. It doesn't have to fill, right? And then runaway gaps are kind of the same thing, but in this case, these gaps are my favorites to trade because they fuel the trend in that specific direction. Now, this is going to speed up the movement. So that's what the fuel kind of comes from, right? It's speeding up the movement, and it's bringing a lot of volume into an already bullish market. So a breakaway gap is basically a, let's say, trending, or let's say a sideways market, or just no specific pattern, no specific trend. It's not a bullish trend, high highs, high lows. It's not a bearish trend, lower lows, lower highs, but it's just a normal trend, right? And it just breaks away from it. Whereas a runaway gap, you're actually getting higher highs, higher lows within the market. And let's say you're in a bullish market, and this is going to be speeding up that movement and bringing a lot of volume into an already bullish or a bearish market, right? So that's where runaway gaps come from. They are also called continuation gaps. So if that helps you kind of understand it easier, continuation or runaway gaps, whatever you want to call it. The fourth and last thing we have here are the exhaustion gaps. Now, the exhaustion gaps are a very interesting one as well that can be capitalized on and actually make a lot of money off these, okay? So I don't see too many of them. I haven't seen too many of them on Bitcoin, but we will look at a few different examples. These are basically the opposite to runaway gaps, whereas a runaway gap is a continuation of the trend. So you're in a high low trajectory, and you're getting that continuation trend, right? You're getting a big gap up. Whereas an exhaustion gap, it's actually, let's say, in an uptrend, and it creates one more gap in the end of that uptrend, then actually starts gapping down. It then actually fills the gap and then goes down further, and that starts the new trend to the downside. So it's just one more basically exit pump, and then we come down, right? So like I said here, these are the opposite to runaway gaps. The price makes a last run and creates a gap in that specific trend, but quickly runs the opposite way. This fuels the trend reversal that has just now started. Okay, so let me explain these to you guys, show you a few different charts, and then we'll get onto the charts as well. So a common gap. What is a common gap? So we're seeing a common gap right here. It's just simply a gap within the price action. Now, we could go through traditional markets. As you guys know, I am into traditional markets as well. We have channels for it on the Discord, but we want to stay focused on Bitcoin because that's kind of what we, what we started on. So we want to focus on these, and I want to show you guys different examples of these because you trade them the most. Now, a common gap, you will see we're on the 1 hour time frame. It can be on any time frame really, but you have a very simple common gap right here. And actually, now looking at it, we have We have a gap down right here. This would be a common gap as well, and then, you know, go up straight away to fill it. And as you can see, it's not like it stops right here. So with these common gaps, you have to be a little bit more careful, because you're not just going to be able to put a short position in here and expect it to, you know, stop right here and come back down. A lot of people think just because there's a gap there, you're going to, you know, blindly put in a short or blindly put in a long position. That's not the way you're going to do things. And in the long run, you're not going to be successful doing that, right? So it's kind of what we want to look at here. This is a normal gap, a common gap, whatever you want to call it, does not matter. But that's what it is. So a breakaway gap. What is a breakaway gap? Now, this is the most recent price action in Bitcoin. So this is a little bit of a tricky one, because you can actually call this a runaway gap, and I will tell you guys why you can call this a runaway gap. So if you were on the lower time frames, and you could make the argument for it on the daily as well, but if we were on the lower time frames, we were actually, or let's say the 12-hour, for example, or the 4-hour, we were making higher highs and higher lows, and then we actually gapped up over the weekend on CME, or we actually gapped up. Okay, so we could consider this a runaway gap, because you know, it was a continuation of the trend, depending on what time frame you're looking at. But let's say we were looking at a 1 day, you could make the argument that this is a breakaway gap. We were in a trading range, which we clearly were for a very long time. Then the price action broke away from this trend. So to quickly remind you, breakaway gaps, this signals a new trend in the market. Price action starts to gap away from trading zone. If you see an expansion in the volume, which we did, this is typically a move that will be maintained and a good idea to get on the right side of it. So as soon as you see this breakaway gap, you want to get on the right side of this, because then after that, we went up another $2,000, $3,000. Right, so you want to be getting on the, or $2,000. You want to be getting on the right side of that. You're not looking for this gap to fill, which, as you guys know, a lot of people are looking for this to fill, or shorting in anticipation for this to fill. But if you are a smart trader, whether you were looking at it as a runaway gap on the lower time frames or a breakaway gap on the daily time frame and higher, you would have been able to anticipate this and play it very, very nicely. So let's quickly go over to runaway gaps now. So this is the third thing that we had. And to remind you guys, what we're looking for in a runaway gap is a already established trend. So in this case, the established trend was a lower low, lower high trajectory. That we were starting a downtrend right here. Okay, we had our high at $10,000, then we started a downtrend. And what happened over the weekend, we actually gapped down $1,000. Now this gap was far too far away, and I actually remember this perfectly. A lot of people were looking for this one to fill as well. And what happened was we actually fueled the trend in that direction. So it gave more fuel to the fire, which actually gave us a $4,000 something move down. And we were already in a downtrend. And as a smart individual, which you are, you would be able to kind of sit there and say, I know about gap theory. I know exactly what this means, and I'm not going to get scared to get on the short side here, because I know that this is already dumped $1,000, but this is in fact a runaway gap. Okay, and I want to get on the right side of it. So the exhaustion gap, what is an exhaustion gap, right? An exhaustion gap is basically where you are already in an established trend. So we are in an uptrend, and it's that one last pump that you get that creates a gap, which you can see right here. One last pump creates a gap, tries one more time up, then instantly comes back down. And then it starts a new trend to the downside. So I couldn't find a very good example of it on Bitcoin, but you know, these things happen in the traditional markets on the high time frames as well, and they can be some huge reversals. So you really want to be looking for these. And this was actually your entry, because as you can see, there's a horizontal level right here. We retested this horizontal level, and this would have been your entry as well if you didn't enter up here. This was your safe entry at around 9,600. Let's say you would have wrote it down all the way to 9,000 on an hourly time frame. Very, very nice. So that's your exhaustion gap. When you're already in an uptrend, then you actually have one more gap to the upside, and then it actually doesn't produce anything and comes straight back down. And there's a very psychological thing with this as well. So a lot of traders just get very scared. The price action has already gone, let's imagine this has gone up like thousands of dollars. It's already gone up a lot. We've had a big move down as soon as we've opened up, filled that gap. It literally didn't bounce at the gap at all. It flew right past it. As you can see, it would have stopped everyone out that was trying to play that bounce from the gap as well, and gave you a very nice opportunity. So exhaustion gaps can be extremely good to play as well, but you don't see many of them in Bitcoin unless you're trading the lower time frame. So without any further ado, let's get onto the charts here, and I'm going to show you guys kind of how I'm going to be trading these, okay, and how I usually trade these, okay. So there's a very it's a little bit tricky at the start because you may be able to identify them, but then picking your stop losses and picking your take profits, especially stop losses is what we want to concentrate on, can be tricky. So the general rule for a runaway gap, firstly we'll start on the runaway gap, is we're seeing this trend, established trend, and then we gap down $1,000. The general rule is to actually put your stop loss above that the place that started the gap. But in this case, even if we entered at 8,250 as soon as that open happened, that would be about a 12% stop loss. So a pretty damn big stop loss, but we know that this is a runaway gap, so potentially it's going to give us some very, very nice gains. In most cases it does. So with a bigger stop loss, that is something that you can consider. That's kind of the general rule for it. For myself, I would be looking to go above a support resistance level. So maybe this support resistance level right here, I would be looking to put my stop loss there. Because if we start going back above here, I think that, this was the big area that we saw, the big continuation. This is where we bounced. If we can go back above that area, I would give my invalidation there. So it's all about context, but you don't always have to be using leverage. You don't always have to be, you can be on 1x trading these things, of course, and playing it, looking at it objectively. So I would probably pick this as a place, or I would go a little bit of a smaller size, but I would give myself a bigger stop loss because I know that this trend is potentially finally, after months of us expecting to see that $4,000 level, which we finally hit, this runaway gap is a great start to get us there. And you can see that it actually got us to $4,000 on CMEs. So a breakaway gap, let's just call this a breakaway gap. Now what I was trying to explain is if we go onto the 4-hour time frame, we already have an established uptrend. We have a low, a high, high, low, high, 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 low, high, 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 low, high, 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 low, and you guys know what I mean, okay? And then we get our continuation. So you could say that this is a runaway gap, but if we go on to our daily time frame, it would be technically considered a breakaway gap, where you're in a range, then the price action breaks away and you want to be getting in on that specific trend. Now again, the general rule that traditionally they talk about, where are you going to put your stop loss? 13% away. I wouldn't recommend that. That's a very smart thing to do, but you want to be getting in on this trend. So you're going to go on the lower time frames. If you guys remember, I was in at $10,080. We were longing from 9,400, but $10,080. We entered on 10,650. We entered on 10,800. But the whole thing is that that there's a gap here. There's a breakaway gap, and that whether you're calling it a runaway gap, breakaway gap, which technically on the daily it is a breakaway gap, you're looking at this as a very, very good opportunity to go onto your spot price action and say, I am going to enter here with an easy invalidation, $300 lower, for example, on this dip. So where do we long? We actually longed, this dip right here we almost nailed this to the dollar. But let's say you actually got this dip down to wherever it was and you manage your risk below the weekly level. Okay, so that's you're trying to anticipate these moves, and that there's a breakaway gap. After such a long consolidation, you're not just going to come down and fill that gap, especially since it's a breakaway gap. Since it's such a long consolidation, you don't just break down, right? So it's all about context and all about thinking about things in the correct way. And I say the correct way because a lot of people say, okay, we have to fill this gap, because every time we've gotten a gap for the past few months, we don't fill it. Right? So understanding about breakaway gaps, runaway gaps will give you more confidence and stronger hands behind the price action. So that's where I would really look for those lower time frames on the spot price action to manage my risk, because this would have been a little bit too far away. Of course, I wouldn't be managing my risk back below this pattern, because if we swung failure back, we would of course fill this. 10,500 has been and will be a nice area to manage your risk. And I've been mentioning that to you guys. So with experience, you'll get it. But let's see, for example, this one, right? So what kind of gap would this be considered, right? Because we're in a uptrend and then we get a big gap down. So this could actually potentially, in my personal opinion, be considered a common gap. Okay, because this would definitely be considered a common gap. Okay, we have about a 9,795, 9,280, about a $500 difference. And then we come up, and as you can see, if you do, some people, this is how they manage their risk. So let's say the gap fill is around 9,820. They will put their stop loss right above the gap fill. But more times than not, that's not going to work for you, because That's where the liquidity is. All the other retail traders, you've got to think of this psychologically. All the other traders are putting their stop loss right above here. That's where the big players will get their liquidity. Okay, big players want liquidity, so they will push the price up there, and where your stop loss is, that's how they're going to get their liquidity, and then it's going to come right back down. So as you can see, it actually pushed back up a few $100, about, let's say $200, over $200, and then it came right back down. So of course, the gap still filled, and then we came back down, but it's just showing you that you should have been managing your stops at the high. That's where I would have personally be doing it. Okay, and gaps are not 100% thing that they're always going to play out. We have another common gap right here, as you can see in the price action, 9,560 to about 9,540. You would probably be able to see this on the lower time frames a little bit better. I do remember this one. It actually got respected quite well. Now, I know a lot of people say that you can't use the lower time frames for gaps, and I would agree with that in traditional markets, but for Bitcoin, we've seen many times that gaps on the lower time frames do in fact play out quite well. So let's look at this one. For example, we have a gap on the 1 hour time frame, a common gap right here. We get a gap down, we come up, let's say this gap is around 7,250, and then we come down, and we do dip down, make a lower low, but then we actually come up. This is a common gap. We don't fill the gap right here because you can see we only came to halfway, right? We actually fill it. I would say that it is filled on this candle. You don't have to be exact with it, but on this next candle, we got it exact. All right, so if I put a horizontal right here, you can see how perfectly that wick actually caught and filled that gap to the dot. And then you got what? A very nice scalping opportunity to the downside. So yeah, 7% scalp, let's say. So that's a common gap for you on the 1 hour time frame. And this is another common gap from about 6,675 all the way down to 6,000, $700 move, and right back up to fill it, and almost to the dot as well. Actually to the dot right there, filling that gap and then reject it. So you could have basically scalped this as well to the downside right here, about 7.5%, then come back up. So if you're using the lower time frames, you're of course scalping these in and out. You're not getting greedy with these trades. You're not trying to make every single trade a 100% trade, right? And this is of course without any leverage. So many gaps that you see within the price action get respected quite well. You want to be managing a risk on these ones, on these common gaps. For example, right here, I would see that there is a clear horizontal level right here. Okay, so I'm seeing a clear horizontal level right here. You're seeing these wicks get stopped, these wicks get stopped, these wicks get stopped. We have a swing failure pattern right here. Okay, this doesn't mean there's no resistance here because we've gone past. This is a SFP, a swing failure pattern, a very simple one right here, and another one right here. So this resistance is being respected quite well. So we can put it on these wicks, which would be perfect. So I want to manage my risk right there. How would this trade look like? It would look something like this, right? You have you have your entry here, you have your stop loss, let's say 4%. So that is a large stop loss, but this is what it's going to take with gaps, right? You're still going to have a two risk to reward ratio. And of course, there's other ways you can manage your risk, but kind of this is how I would be doing it. If you wanted to like really put it close, then of course you have another horizontal level right here that this wick got stopped at, this wick got stopped at, these wicks, this wick. So there's a lot of support resistance here, and you could have put it right here, and it would have only been about a 1.4% kind of stop loss, and usually they get respected quite well. So that's really about it, guys. I want you guys to really start looking for these over the next few weeks, over the next few months, and get familiar with them. They are absolutely amazing opportunities within the market to trade, right? Gaps are basically a gap in the price action, very simply put. And what they basically give you is opportunity in the market. So because CMEs has opened now, we have pre-market trading for Bitcoin, which we have never had in the past, or we haven't had until the 2017 when CMEs did come out. So it gives us opportunity to anticipate those moves, to get in on those moves. A lot of people trade these wrong, or they just simply don't even know about it. So as a trader that's looks for these things, you know about them better and you can capitalize on them. Now, they can be very profitable. And one last thing, I do want to make a very quick comment about traditional markets, because traditional markets play a little bit different. Now, how are traditional markets kind of this can happen for Bitcoin as well, but for traditional markets, basically when you get, for example, you have post-market trading and you also have pre-market trading, which usually most people cannot trade in those. The bigger players trade in the post-market and the pre-market, and that's when your gaps are created every single day in traditional markets, because every single day we have closures depending on which traditional market you're trading. And mostly you get movements within these when you have news. For example, you have a I don't know, let's say you get a new CEO for the company, or you have new stores opening up, or some big news that can affect the price, and then the pre-market and the post-market will move. Or for example, you have I don't know, the big thing actually is earnings, right? If you have a good earnings call, or just simply before earnings come out, you have big moves, so, or in anticipation for the earnings. So that's about it for me. Thank you guys so much for watching. Let me know if you have any questions, and I think that's really all I want to talk about. So I'll catch you guys in the Discord.